Good afternoon, everyone. I hope you're able to see me. Um, you can see the questions in the chat box on your right hand side. If you're able to see me, hear me, please let me know in the chat box. I hope you're able to see the chat box here on the right hand panel. Okay, great. So I have a few questions already. So I'll be taking those questions towards the end of this session. You have been logged in as a listen only mode, so you'll not be able to unmute yourself unless and until I unmute you. So we'll start the session, and then towards the end, in the last 15 minutes, we'll take your questions. Okay, so in between, if you have any questions, you can put it in the question box that you see on your screen. So first of all, thank you very much for taking out time on a Sunday. Today is a special day, which probably will not be able to see, which we hope we don't see again in our remaining life. I hope everyone is safe and fine and enjoying time with family. So the purpose of this call today was me and Manoj were contemplating to connect with all the investors because of the events that has happened in the past couple of weeks. Such kind of events does not generally happen, but when it happens, it creates a lot of anxiety, fear, tension across all the investors. So we thought that we'll address, and if there are any questions pertinent to the situation, we will answer those. Okay. So I hope you're able to see my screen. So the agenda for today's session is basically understand what is happening in the market, what are the reasons for it, how are the global markets reacting, or is it only confined to India that we're seeing such carnage? What are the things that market not factoring in? What factors are causing this market to fall down, and what are the things that markets are yet to factor in, because of which it is expected that the markets will start performing well in the near future. And then the big question, what should the investors do? What are the different things that are there in investors' mind? We've got some key statistics to share with you of what the valuation looks like now, and did we face any such situation earlier? If yes, then what was the uh, numbers then, and how much time it took for it to recover? And then lastly, what are the things that you need to do? And then we'll open for question and answers. Okay, so this is our outline. So I have Manoj with me on the other line. He's also taking the call from his home. Manoj?
Yeah. Can you hear me?
Yes, I can.
All right.
Great. So Manoj is going to take the second half of the session. I'm going to begin with the session. So let's be all aware what's causing this market panic is mainly because of the current coronavirus issue that we are all facing. So the day WHO declared this as a pandemic across 150 countries was the day when a lot of people, including governments, including markets, they saw that there is a lot of issues that are going to happen in the future, and because of which they wanted to be a safe bet, and a lot of money was pulled out from the markets. That was mainly because of the panic and fear. And currently, as we speak, there is no known cure to this issue. But I'm confident that as and when there is any kind of good news in terms of any vaccination getting invented for this particular problem, you will see a lot of this ambiguity, fear vanishing away in a matter of time. Okay. Plus, we are also seeing that the steps that governments are taking now across the globe, specifically the lockdown situation, that is impacting a lot of businesses big time. It's basically causing a lot of losses on a day-to-day basis. Businesses were not prepared to face such kind of issues, and their revenues are getting impacted. The good news is that government across the globe have come up with certain solutions. They are helping the businesses stay afloat. They are coming up with measures. They are pumping in liquidity. So that's a good thing. The major issue that we have seen in the market carnage that has happened in India over the last 10 days is because the foreign institutional investors have pulled a lot of money. So if you see this figure, about $6 billion worth of shares were sold in the Indian markets, and then that money was taken back to the respective countries, because of which there was a mayhem that we saw. So markets continue to go down, but we saw that on Friday there was some respite and markets showed some early signs of recovery. But we don't know how far it will sustain. Will it still further go down? Will it go up? No one really knows. It's only time will tell us what's going to happen. That's for sure that as and when things get a little stabilized, you will see that there will be stability in the markets as well. And some point of time, it will start going up. Okay. Uh, Now, the good thing about the markets that has happened differently over the past few years is that uh, earlier it used to be only foreign institutional investors who were in the commanding position, and they used to put in money, market used to go up, and then whenever there was a time of their withdrawal, the market used to tank. But fortunately, the domestic institutional investors and retail investors have been pumping in money every month. And if you actually look at the numbers, the money that is coming through the route of SIPs, about 8,500 crores each month. So all, including you, me, are contributing to this contribution of 8,500 crores. And that is somewhere helping the market not correct too much as it was expected. And you will also see that a lot of domestic institutional investors are now seeing a lot of valuation correction, and they are now wanting to put money. There are a lot of smart investors who are finding this level attractive. So you will see in the coming weeks, coming days, a lot of this money would come in. Whether this will take the market up, I don't know. No one knows. But definitely people are putting money. The other change that I'm seeing in the behavior of investors, because I witnessed the 2008 market crisis also, but compared to the fear that was there at that point of time versus what it is now, I see some investors willing to put in more money. That was not the case when such kind of crisis happened because of some other reason back in 2008. But that's the change that I'm seeing now, which is good. Another cause is that specifically a lot of US based hedge funds, what they do generally is they borrow from their country at a percentage of say 1.5-2%. They get that money to India, they invest, they tend to make some arbitrage returns, and then they pay off their liabilities. But when this market carnage started happening, these hedge fund managers who had borrowed money at an interest back in US, they saw that they were not able to meet a sufficient amount of returns to collect their interest. So they started unwinding their leverage position. So leverage position means I'm borrowing at say 2% and I'm investing in an instrument which is expected to give me more than what is my borrowing cost. So hedge funds, algorithm based funds, so all these companies who are running some kind of funds, they started unwinding, they started selling off so that they can cut down their losses. So they don't end up with two kind of losses. One is because of the equity markets going down, and the other one is they don't have sufficient amount of interest or a sufficient amount of money to pay back the interest. So this is what the background of the market carnage is. Now moving on, I wanted to show you, has this event been the first of its kind, or have you seen similar events happening? Now, every 2 to 3 years, if you see, there are some of the other events that are happening. The reasons for this market crash or market correction is different. However, the corrections, when it happens very sharply, and a lot of investors do not get time to react. By the time you react, the market is already down 20-30%. So here on this slide, you see that the journey six for the last 23 years, starting with July 1997. So if you see, there have been almost 7 events, including the one that we're facing now. And every time an event has happened, because of a particular reason, the market has tanked. So the first event in the last 23 years was the Asian financial crisis. I was back then in school, so I don't remember this. And at that point of time, there was very limited coverage on TV as well. We did not have mobile phones, no limited internet, so we did not cover it. Uh, the reason maybe it is causing too much of panic nowadays is because of media. A lot of circulating messages, posts on WhatsApp, Facebook. So that's actually adding to the fear. Okay, but such kind of events or maybe adverse events than what you're facing now has happened in the past. But because there was limited coverage, limited dissemination of information, so those things didn't have much impact. But if you see the biggest event out of the 7 events that you see here has happened purely when the subprime crisis busted, and where the market tanked in a matter of 2 weeks. It tanked by about 61%. But we also what happened post that, in about 9 months post that market crash, there was a recovery, and then market again went up where it was originally. And then again, there was a European debt crisis, which again scared the market. There was again a drop in the year 2011. Then we saw in 2015-16, because of the global market sell-off, crude price going up, again there's uncertainty. So what I'm trying to say is that in the future years also you'll see such kind of uncertainties. The reasons might be different. What you need to see here is whether you're optimistic about your future 5 years down the line. If the answer is yes, continue investing. Things will be better in the times to come. Okay, so that's what I wanted to show you in this slide. Then here, if you see how has the global markets reacted to this coronavirus issue, is it only India who reacted sharply, or is it across the globe? So if you actually see this bottom line, the emerging market shares, basically it consists of all the emerging markets like Brazil, Russia, China, India. So there you will see that our markets have not fallen that much as compared to some of the European markets, some of the South American markets, as well as the world consolidated indexes that you see in the form of these ETFs. So our markets have fallen, but not as sharp as what other indexes have fallen. Okay. Another thing is that if you look at this market fall in the last 1 month, it has fallen by about 28%. And roughly, that was the return that we made in the last 1 year. So more or less, we are kind of flattish. If someone has invested in the last 1 year, has basically either has a flattish return or some bit of negative. So this is what the change that has happened. So it's across the board, not only restricted to India. Surprisingly, you will see that China, where it all originated, their markets have now stabilized. In fact, in the past few days, the markets are a little positive, wherein the global markets are falling down, the Chinese markets are recovering. Maybe they were able to contain this on a war footing. We all saw in the news how China enforced lockdown, what are the kind of medical facilities that they were able to build, what are the kind of measures that they took so that it should not spread further. So those kind of things have restored confidence in the Chinese market. That is why you will see that the fall is not happening. On the contrary, it is kind of positive. Okay. So as and when you see these things happening across other economies, you will see that our economies or our markets also stabling or probably trying to move up back. Okay. So that's what is happening in the global markets. Now, this was the slide that I took on 19th of March before yesterday when markets closed. So if you look across the globe, major economies or major markets closed on a positive note. Okay, so barring Canada and US, most of the markets you'll see that they have closed in green, and we are the second highest return generator in terms of the markets closing at 5.83% higher than what it was the previous day. Okay, followed by some of the South Korean markets. So we see that one positive news now. What has caused this is because the government is coming and intervening in the situation. They are, so if you would have read in the newspaper that France government has declared tax holidays, they have declared moratorium for EMI repayments. So a lot of things government is doing on its level. They are infusing liquidity. You will also see that the central banks are reducing interest rates so that they can create liquidity so that people can have money. And on 18th of March, our Prime Minister also addressed the entire nation, and he did mention that he will be forming an economic task force. So that's also positive news. That means the government is aware about the ground situation and is trying its best to do whatever it can. So all this positive news is helping the markets to recover. Now, whether this recovery will sustain on Monday, will it go down, will it stable? No one knows. It's only in a week or two, as when we look at the situation, whether it is improving, not improving, only then we will be able to know whether the market remains status quo, or it moves up or moves down. Okay. But what I'm trying to say over here is one good news, the market is going up. One bad news, it tanks badly. Okay. Now, there are certain things that the market is yet to take in account and that should ideally show positive impact. Had the coronavirus impact not been great, then these some of the events that has happened in the past 2 to 3 weeks have shown positively on the markets. So first of all, what has happened is that whatever is the value of the company across the economy, which we call it as market cap. So there are more than 5,000 companies that are registered and listed uh, in BSE and NSE. If you look at the total value of all these companies after this market carnage, it has fallen to about 60% of the value of the GDP. Okay, so what GDP means basically, what is the value of assets or services that we generate as a nation. So if that is say 100 rupees is the value of the services and goods that we produce in a country, the market value of all the companies has fallen to about 60 rupees. Okay. Usually this is the case when there is a sharp correction. And whenever in past we have seen that the market cap has reduced drastically as compared to GDP, you have usually seen an upside wherein the markets have started moving up towards the GDP number. So if you see here, there has been a 40% fall in the market cap as against the GDP. Usually in good markets, the market cap is about 95 to 97% of the value of the GDP, which has taken a beating. Okay. Now, this level is similar to what we saw as a level post the subprime crisis. At that point of time, the market cap to GDP ratio was about 55%. We are more or less close to that level, which had from here on, whenever the recovery happened, it is showing all positive news. So that's the first thing that is remarkable in this downfall. The second is that the oil prices, which was again a concern for countries which were importing and their current account deficit was getting increased of the high imports of crude oil. So there has been some respite there. So what was about $68 per barrel about a month ago has come down to about $29 per barrel. So what it means for us as a country is that our import cost will reduce drastically. So just to give you an idea, every drop in the crude oil prices basically helps India save about $1.4 billion. And that's a huge amount of money. That's a per day value. So imagine if such kind of thing going for a month, we'll be able to save about $46 billion, which is roughly about 12% of what we have as a foreign currency reserves in terms of USD. So that's a good amount of money. What this will do is the government to curb the foreign account deficit. So basically, how much we export versus how much we import, whatever is the difference is usually negative, but that negative difference will come down because of the drop in the oil prices that has happened over the past 1 month. So it's a good thing for India as a country. They should also play a role at some point of time during the market reversal. Another thing that I mentioned a while back is that the central banks are cutting interest rate across. Now, until today, we haven't heard any announcement by the Reserve Bank of India. But the way things are moving on, we are expecting that there'll be a rate cut, which means that the interest rates will go down. There'll be liquidity available in the market. People will be able to borrow as a cost. The loan cost will go down. The flip to it is that if you have FD, interest rates will be cut. So not a good news for FD investors. Yes, but people who are borrowing or who wants liquidity at a lesser cost, it will be good news for them as and when RBI decides to cut the interest rate. And both of us think that the week we should hear this announcement from RBI because majority of the central banks have already done those interest rates. So the first country to cut the interest rate, one of the first country was the Fed Reserve of US. So they have made the interest rate near to zero, so that they can liquidity and they can take care of the situation as far as possible. Okay. And I also mentioned that one of the reasons why the market went up by about 1100 plus points on Friday is because Prime Minister also communicated that they are in the process of forming an economic response task force, which will help address some of the issues that businesses are facing and any economic issues that might surface post this lockdown kind of eventually pans out. Okay. Another good news is that since China was bad, and there was uh, a lockdown in majority of the cities that impacted their productivity. So a lot of the other countries which were dependent on China for a lot of their raw materials, they now think that diversification is something which is necessary because they cannot be dependent on one country. Because if anything happens to the one country, similar to what we are facing now, then it has a lot of impact on their input material, which will not help them to produce the goods that they are uh, producing, and that will incur additional costs. It will be delaying the delivery of those products. So a lot of these companies are trying to diversify their manufacturing activities to other countries, and India is likely to benefit from this diversification, partly because in October the finance minister has declared that any business setting up shop will be allowed to pay only about 15% tax. So that's almost 50% tax cut, and comparatively our labor is also cheap as compared to the rest of the world. Okay, so these are some of the things which are positive, but getting hidden because of the fear and panic that is happening across. I think Manoj, you have to add something here.
No, I think good enough.
Okay. All right. So now, what's happening? This is the prime question. So what should we do now? Okay. So like I said, it's all fear and panic that is happening. You will see a lot of people selling their stocks, selling their equity mutual funds. You may be also feeling when should I be selling? Should I be sitting tight? Should I be adding more? Should I stop my fresh investments? Some of the people may also be thinking, should we add more to equities? Okay. So I'll be answering these questions one by one. So first of all, if you think of stopping the investments, the mistake that would happen is that if you look at the way the market has corrected, the NAVs of the mutual fund schemes as well as the stock price, if you're a direct stock investor, the stock price has corrected a lot. If you talk about companies like SBI Bank, HDFC, Reliance, these stocks have corrected in the tune of 30 to 40%. Okay. Now, if you actually look at these companies, fundamentally they are strong companies. So why such a fundamentally strong company's stock price is taking a beating? It's no one's guess to say that it's because people are fearing, and every time a carnage happens, people have the feeling that it's the end of the world, but it never is. So maybe when things stabilize, you will look back at this period, and then if you take any negative actions right now, you will feel a regret maybe at that point of time that why you did take some action which was counterintuitive to the investments that you made. So this is not the right strategy to do now. So hold your investments, because at this point of time, the number of units that your investments will buy will be more as compared to what it was about a month ago. So that's one. Second, people who have got more money in the debt instruments. So if you see in the last 1.5 years, any big money that was supposed to be invested by investors, we never recommended them to invest in it. So we always insisted that if you want to invest in equities, you spread that out over the next 12 to 24 months. Don't put a lump sum, because valuations were looking very. But today, when the valuations have come to a deeper level, so this is the right time to invest into equities. But again, we are cautious. We are not recommending to put one shot. What we recommend is spread that over the next 2 to 3 phases. So whenever you see a shot, say you have 100 rupees to deploy from your debt mutual funds, or you have some liquidity sitting in your bank account, which you at least do not need for the next 3 years, and you're okay to see that value going down by say another 20 to 30%, only get that money into the equities. But if you do not have that kind of horizon, if you want that money in the next 1 year, or you cannot see your money value going down further, then I would not recommend adding any more money into equities from the ones that you're already contributing towards the long-term goals. Just continue with that, but don't put any more money if you don't have at least 3 years horizon. Why I'm saying 3 years is because we feel that that's the maximum horizon that it should take for it to recover, if at all it takes that long. Otherwise, in the next 3 to 6 months, we will see some kind of recovery, is our gut feeling. But again, like I said, no one knows how deep it could go or when will the recovery happen. No one knows, but this is what our assessment is. So, bottom line, if you've got money sitting in a debt fund which you don't need for 3 years, or you've got money in equity in savings account which again you don't need for at least 3 years, and you're willing to look at that money 20-30% probably going down further, then that money should come into equities over the next 2 to 3 phases, which could happen in the next 1 or 2 weeks. Okay, so we'll chat about that separately. Now, the third question: how long will it take markets to recover? Our assessment says another 3 to 6 months, ideally, but we may be wrong. It might take longer. So we really don't know how long it will take to recover at the level at which it started falling. Next question is how much more fall is expected. Honestly, we don't have an answer. But looking at the valuation, we feel that it is already bottomed out. If at all it falls further, I don't see more than 10 to 15% correction beyond this level. So that's the maximum fall that I see. But you never know. There are no precedences to such kind of events. So anything could happen. But this is what our assessment is. How long will this go? My guess is till the time we don't have any positive news about any virus or about any vaccination to contain that virus, or we don't see the cases going down, or we don't see any new cases coming up drastically. So that is where markets will start stabilizing. You could also have a thought that I exit all my investment at whatever losses that is and probably keep my money in the savings account, or maybe use that money and create an FD, say for 1 year. You can do that, but you also need to look at what are the losses that you will actually end up doing. First is that whatever losses that you see right now in your equity portfolios, these are notional losses. So if you actually withdraw, those notional losses will convert into confirmed losses, which maybe the market recovers. If you're not there in the market, you may have lost the opportunity to recover a substantial amount of those losses. That is one. Second, if you still go ahead and withdraw all the equities and probably park it in the savings account, it's hardly going to help you earn about 4%. And if you consider taxes, after the taxes, assuming you're in this bracket, you're barely making about 2.8 to 2.9%. Okay, so that's again not helping you. And like I said, when RBI decides to cut down interest rate, today as we speak, the FD is not very encouraging. It's in the range of 6 to 6.5%. That to pre-tax, post-tax it's about 4. No, has been stagnant for almost 6-7 years. But even if real estate has been stagnant, no one is actually worried about it because you really don't get to see the valuation of real estate every day. What happens is that because it is liquid, you get the portfolio values. When you log into the app, you see that the value is going down. That is when the emotion starts playing out. But the similar thing has been happening with real estate as well. Either the value has fallen over the past 6-7 years, or the value has not increased. It is at the same level what it was. Plus, the FD rates have also fallen in the past 3 years. There was a time when it used to be at the rate of 8 to 8.5%, maybe at 9%. So today, with any good bank, you're not getting more than 6 to 6.5%. So things are not great in other instruments as well. Okay, so that's what our suggestion will be to you. And personally, me and Manoj, we have a good amount of allocation towards equity. In fact, we are allocating money from whatever we don't need for the next 3 years, which is there in debt. We are allocating that money into equity. We have contributed a good amount of money over the past 10 to 12 days from debt to equity. So this is what we are applying in our own individual portfolios, and we are suggesting the same to all our investors. Okay. So Manoj will take over and talk about some of the key statistics that was there in 2007 versus what it is there now. Manoj?
Yeah, thank you so much, Vinit. Good afternoon, everyone. Vinit, am I audible?
Yeah.
Okay. Can you just move to the next slide because I'm not able to see the slide, and I'm sure even the participants are not able to see it because of some delay. Yeah. Okay. All right.
Are you able to see it?
Sorry, you're saying something?
Able to see it now?
Yeah. All right. Okay. So I think we've got a good brief from Vinit, and there are certain things which I wanted to talk in terms of the statistics. Comparing this whole situation to the crisis of 2007-8, which we saw in form of the subprime crisis, and eventually the global meltdown which happened because of that. if you look at the 2007, December 2007 was the month which made where the market really made the first peak level of 20,500, right? So that was the peak, and obviously everything was looking very optimistic and positive about the economy, because even GDP was growing at around 9.5% at that point of time. Uh, the moment the subprime crisis happened, the market tanked drastically, and which we saw the correction in form of roughly market falling from 20,200 level to 8,900 level in Feb 2009. So that was the bottom of the market, and from there, obviously, we saw some drastic pullback happening in next 6 to 7 months. However, in terms of the statistics, like the key statistics on which normally we try and see and understand whether the markets are how they are valued from the valuation point of view. The key indicators are obviously the price to earning ratio, which most of us are aware of. Apart from that, price to book value ratio. And the third, which is very important ratio, which we see it as a market cap to GDP ratio. In 2007, when the market, in December 2007, when market peaked at 20,200 level, at that point of time, the price to earning ratio of market was around 27 times. Price to earning ratio was around 6.5 times, and market cap to GDP was around 149%. So that means the market cap was more than the overall size of the GDP at that point of time. In 2009 Feb, when market corrected to 8,900 level, we saw the price to earning ratio correcting by almost 50%. So that means market price to earning ratio from 27 times came down to almost 13 to 14 times level. The price to book value ratio also came down from 6.39% to 1.90%. And the market cap to GDP ratio, which was 149% at the time of the peak, came down to almost at 55%. So that means the market capitalization of all the 5,000 listed companies were half of the GDP's size. Now, the point why I'm trying to basically give this statistics to you, because we are trying to make out some correlation to the situation of 2007 and this situation where we have seen such kind of drastic corrections happening in last 10 to 12 days. Before this fall, where we saw market closing to around 27, 28,000 level, now obviously markets are at 30,000 level. Somewhere in December, Jan 2020, market made a peak of 41,000 level. If you look at the peak of market at 40,000 in Jan 2020, where again the price to earning ratio of the market was 26 times, which was very close to the levels when market really made the peak during the subprime crisis. The price to book value was trading at around 3.37 times, and the market cap to GDP ratio was around 77% just a month back, 2 months back, in fact. If you look at the situation now in March 2020 as we speak, the price to earning ratios of the market all the way from 26 times have come down to 18 times. Price to book value has come down to 2.1% to 2.1 times, and market cap to GDP ratio has come down to almost at 60% level. Now, what does it mean to us? If you look at from the valuation point of view, the long-term average of the price to earning ratio of the Sensex and Nifty has always been around 16 to 19 times. So whenever we see the valuation of markets from price to earning point of view, if they are in the range around 16 to 19%, we consider them to be at a fair valuation. If we see the price to book value ratio in a range of around 2.2 to 2.25%, 2.5%, that considered to be as a long-term average, and we are somewhere bottoming out to those long-term averages. The third important statistics of market cap to GDP, the long-term average has always been around 75%, and at this moment as we speak, we are at around 60% level. So if you look at, there are two things which we are trying to make out from these statistics. One, almost from the peak and the fall of the peak of 2007, a valuation at that point of time and the valuation at this time, we are coming close to the valuations of those times. So that means markets are coming into a very fair valuation zone, and somewhere it is signaling. Obviously, we are not trying to basically predict the levels of the markets from the valuation and from the price point of view, but somewhere we are feeling that it is coming to a fair valuation level. And I think this is the time from where, instead of getting a panic situation and making some emotional decisions in equities, I think this is somewhere we need to start pulling back to the equities as an allocation. So these are the certain statistics which we wanted to basically share in terms of the valuation of the markets. Uh, if you look at the returns which markets had generated in 2007 before the market tanked to the lowest of the levels, uh, almost in a range of around 40 to 50% is what we saw as a 1 year, 2 year, and 3 years return. At this moment, the markets are obviously not looking to be positive, obviously not because of this recent fall, but even before the recent fall, the broad market never participated into this whole rally. So whatever we saw, the 40,000, 41,000 levels of the market, it was not the small caps, mid caps, and the all large caps who were participating in this whole rally. There was very stock specific and very sector specific pullbacks which had happened, and that's the only reason why majority of the portfolios were not looking to be great, except obviously Sensex levels going up every time. But in this whole correction, what has happened that the stocks which rallied in this whole momentum, they also got corrected. At the same time, the small caps and mid caps have also corrected to a very drastic levels. So in a nutshell, I think we have seen the price correction, and in the whole process of price correction, we have seen a valuation correcting to a large extent, which is making markets to be very, very attractive from price to earning, from price to book value ratio, and from a market cap to GDP ratio. So somewhere we are at a levels of bottoming out, but whether this bottom is a real bottom, we can't say with 100% precision. But I think that gives us a very, very fair comfortable situation to gauge from our past experiences that yeah, we are somewhere near to bottoming out in terms of the valuation. Can we move to the next slide, Vinit?
Yeah.
I think we can go to no.
Should we move on to the next one?
Yes. Move to the next one.
Okay.
The market impact of different epidemics. That's the slide I want now.
Yeah,
I think it's not.
it's on.
All right. So, however, I'm not able to see the slide, but so what we are trying to do over here is that give you a situation of the similar kind, like the coronavirus, the kind of other epidemics, basically, which occurred in past. Obviously, the first one is the SARS, which happened in Jan 2003 till March 2003. We saw the market outbreaking to a level of almost by 10%. And in the next 1 years, once the market was bottomed out, the 1 year return was close to around 83%. Similarly, with avian influenza, which happened in 2004 to August 2004, we saw the market reacting very sharply to it. And again, the returns for next 1 year were almost in a range of around 50%. Ebola also gives us a similar experience in terms of the markets falling or remaining stagnated. But again, in next 1 year, we saw market delivery 40% return. Similarly, with the Zika virus, where we saw 15, 16 November to Feb, I think market reacted and corrected by almost 13%. But again, the pullback happened, and the returns were for next 1 year was around 24%. Coronavirus, the data is relatively old, but as we speak, we corrected by almost 30% at this moment, which is one of the highest fall which we have seen because of any epidemic situation arising in the world. We don't know in terms of the next 1 year return how much would the returns be, but having said that, uh, the market pullback of or almost by 5.5-6% on Friday itself is one of the example because of the ample liquidity which is there into the system, and obviously some smart investors and large institutional investors who are not very emotional about the market levels and they don't react to their emotions. I think that's where the pullback has happened, and we saw almost 5.5 to 6% of pullback happening on Friday. Now, whether the markets will keep pulling from here onwards, we can't say that. But from the valuation point of view, the levels where we are right now, I think we are definitely going to expect the pullbacks to happen sharply. Maybe most of us may not get the we may not get the time to basically time the whole situation, but definitely these are not the bottoms of the level. We are going to definitely see the pullbacks happening very sharply, as we have seen in the other falls of the market, including the epidemics as well as the subprime crisis. So pullback is not going to be, don't get surprised if you really see some immediate pullbacks happening in the market. So that is the one thing where we have to basically be looking at as an opportunity in the market. Uh, can we go to the next slide, Vinit? Impact on the sectors.
Yeah, I'm on the slide.
Yes. Okay. So basically, what we have tried to bifurcate is in terms of understanding that which all sectors of the markets are going to have a high impact, moderate impact, and the low impact because of all this whole situation. Uh, I think somewhere the services are going to see a drastic impact, like airlines, hotels, malls, multiplexes, restaurants, retailers. All the retail consumption-based sectors are going to see a major correction. Obviously, steel as a sector, textile as a sector also will see a good impact, negative, high impact, in fact. And we have observed those impacts in the recent correction. The moderate impact where we feel would be the automobiles, auto components, information technology, petrochemicals, renewable, consumer durables, and electronics. Uh, the low impact sectors would always be your pharmaceutical. Financial sector somewhere may move from low impact to moderate impact or even to high impact, depending upon the situation of non-performing assets being declared by these banks, in case if the situation deteriorates. But as of now, as we speak, we have not seen banks or any NBFC sectors to be reacted so sharply as of now. But we remain very cautious on the financial sector per se, because this whole situation is going to definitely impact the earnings of the companies, the paying capacity of the individuals, because of the whole recessionary situation. I think banks may get into a situation where we can see some kind of a stress, but we are watchful about financial sector as a sector to be seen now. Uh, so these are the broad, basically, sectors where we feel the impacts are going to be. However, from the allocation point of view, the portfolios where we have invested are largely diversified across all these sectors. So obviously, we are not going to get impacted too drastically because of any specific sectors falling or not falling. Somewhere the impacts are going to be marginalized because of the bifurcation that has been, and the allocation that has been done due to the diversification of the portfolio. So Vinit, can we move to the next slide, which is the last slide? Uh, our strategy going to be the way forward in terms of our suggestion to all our clients is that let's not lose our sight from our long-term financial goals, because that is something is not going to change, and it should also not be changed based on the current situations, because definitely these situations are not going to be a long-term one. We are going to see the pullbacks really happening very fast, and these kind of corrections are not for the first time that we have ever seen. These situations have always come in and gone. So somewhere the financial goals are more important than reacting to these market situations. Somewhere from a valuation point of view, market needed some reason, and I think it came in form of coronavirus as one of the reason. And till 2 months back, we were not very comfortable with the levels of the markets. But since all our clients, majority have been investing through systematic investment plans, so we were not worried about their investing, because at all levels purchases were happening and investments were happening. Uh, in that situation, I think the correction has happened for good. Maybe we'll have to keep ourselves very, very safe from the coronavirus, but from the investment point of view, I think valuations have corrected, and that makes us very comfortable to look equity as an asset class. And let's not lose our sight from financial goals perspective. Uh, our financial plans have ensured that money required over the next 5 years are in debt funds. So we have definitely maintained your emergency fund, and due to the asset allocation, we have never invested 100% of money into equities. I think 30 to 40% of money has always remained into debt funds that can be utilized basically to rebalance our portfolios, because somewhere due to this sharp fall, uh, the equity allocation has definitely come down. And I think on a one-to-one basis, we will be getting in touch with you in terms of realigning your portfolios to the long-term asset allocation, where we'll have to move the money from debt to equities eventually, but it will be happening in a gradual manner. Uh, let's have courage and patience to ride this roller coaster ride, because I'm sure this is not going to be an easy situation for any one of us. We all are afraid because of the market correction, at the same time because of all this outbreak of epidemic. So we are afraid, but we are not paralyzed. So I think somewhere we'll have to maintain our patience, we'll have to maintain our courage to see through the situation passing by. We'll have to maintain our discipline of investing, and hoping that the future is going to be brighter and better. uh, till then, maybe stay safe and stay healthy. We wish everyone to take utmost precautions and safety in this testing times. I think this is a very important quote of this too shall pass. So we'll have to be really optimistic about our future rather than just focusing upon these knee-jerk reactions. So thank you so much for this. I think with this we will open the webinar for question and answers, and we'll be more than happy and Vinit in terms of taking your questions.
Okay, so another question is, should we stop allocating money into debt and route them into the equities? We continue with the same asset allocation. We're just talking about any lump sum money which is excess. So, for example, if your asset allocation is 30 and debt portion has increased from 30 to say 40%, that extra 10% could come into equity. But if the proportion is same, then we don't recommend increasing the equity allocation from debt. It's only something excess over the set allocation that can be looked at. Okay, so the next question is, is it good to invest FD money into blue chip stocks? So the answer is that if it is part of your emergency fund, then definitely not recommended to move that money out of FD. It's only if you did not use that money for 3+ years, then only you can start putting that. But again, in phases, not lump sum, because blue chip stock is not a guarantee that it will not fall. You have seen good companies like SBI, HDFC, Reliance, Bajaj have taken a beating in this market. So fundamentally they are strong, but market emotions don't look at fundamentals in the shorter period. So if the money is for emergency, stay invested in FD and not in equity. Okay, so the other question is, this is not similar to the previous outbreaks we have seen in a lifetime. I agree that this is not similar, but every time it's a new thing and at a different level. Maybe 10 years down the line, there will be some other event which probably we would have seen it for the first time. Every event is a first time event. And no one knows how deep or how long it will last. So I agree to what you're saying. Okay, the next question is, good time to get into direct commodities? Not sure because we don't track commodities that well, but there have been volatilities in commodities as well. But you can take a call, and then if you have some previous experience in commodities, because we have very limited information on the commodity segment. But if you have information, then probably you can look at that. Okay, the next question is, if we did not originally plan to invest in an equity at this point in this time, then looking at the current scenario, it is advisable to reconsider and use some of the funds that would have otherwise been invested in debt funds. Yes, we can do that, but Akash, in your case, we are looking at some shorter-term goals. So not in your case at least. But if it was a different case, then probably yes, we could have looked at some debt funds, but not in your case, Akash. Okay, then another question: comparison to past market situation, which were global and had impact on Indian market, while with COVID-19 has impacted almost all the countries as well as in India, we had financial sector issues like Yes Bank. So do you think the situation is more deep? Situation may have longer time to recover. Honestly, Ashish, we don't know what is the depth of this situation. It's true that this is a global pandemic, one of the very rare epidemics to have been declared as a global pandemic. But we have also seen other epidemics to be impacting other countries. But the prevalent scale in which it has impacted globally, I think it is by far the first. So uh, see, logically, if I see a person may not want to sell at this point of time. If he is already sitting on a say 30% loss, he may not want to take such a big loss, so might as well not take any action. So even if the market goes here out of fear, I think another 10-15% should be the bottom. If it goes beyond that, then no one can do anything about it, right? So that's the thing. There have been financial sector issues in India, which I agree, but again, that's more of a corporate governance issue rather than the entire sector issue. And government is doing well to cater to these issues on a timely basis. And looking at the way the RBI has managed the situation, and they have pushed RBI, SBI to take some controlling stake. I think this is one of the issues that has happened. We may not see this kind of things happening in future. Okay, so this is where next question: is it good time to invest in shares? Yes, if you have the appetite and the money which you can spare for at least 3 years, then you can look at direct stock exposure. However, one thing you need to look at is that if there is a negative thing, mutual funds will fall lesser as compared to direct stocks. And you would have all seen that happening recently in your mutual fund portfolios. So if you have a stock portfolio versus a mutual fund portfolio, mutual funds have fallen lesser because of a more diversified portfolio as compared to direct stocks, which would have taken some sharp correction. But if you have some stocks and you're willing to stay invested for 3 years, a good time to invest in direct stocks.
Uh, I have one question which has come to me on my WhatsApp. It is from Anshul, and it says that we knew that the situation was developing. Why were not moving money away towards debt or safer funds or bonds, as we had ample time, and re-enter at these levels? Uh, Anshul, I think somewhere everyone knew that the situation is emerging, but no one had any understanding the gravity of the situation and the kind of impact that it could have really created on the markets. That's point number one. Point number two, basically the the way the markets have fallen. In fact, in the trading sessions of 7 to 8 trading sessions, I think it was very difficult for anyone to time this situation because the falling markets are really like a falling knife, and it will be very difficult to catch them. It can really create a lot of damage in your portfolio if you really try to time and exit from the falling markets from your exit in falling markets in your portfolios. Uh, the third, which is very important point that I want to make, is that we don't try to time any situations in the market because timing is something which cannot be done with 100% precision, and that's the only reason why for all long-term financial goals of our clients we invest through systematic investment plan or systematic transfer plan, so that we don't have to get into a situation where we are trying to time the market, because that is something which cannot be done by anyone with 100% precision. uh, Somewhere what we can do at our best when the markets have corrected, the asset allocation would have also got changed. So in case if we were investing 70% into equity and 30% into debt, because of this fall, the asset allocation would have altered. What we can at best do is that in this situations of the market where price and valuations have corrected, move some money from debt to equity so that we are maintaining our long-term asset allocation for your long-term financial goals. So I hope I have answered this question, Anshul. Vinit, anything that you want to add in this?
No, I think you have answered sufficiently. Okay, so I don't have any more questions. I hope you found this session useful. We overshot by about more than 25 minutes or so. So thank you everyone for being a part of this session. If there are any more questions which we have not been able to answer in this session, feel free to call us, either me or Manoj, and we'll be more than happy to answer this. We'll be also sharing the recording of this session in case if you have any issues in accessing some part of it. Right. So for now, so take care of yourself. There is a family, and stay at home, and we'll connect soon. Thank you very much.
Thank
Have
you
a good day
so
ahead.
much, everyone.